welcome to those of you joining online. So today we are discussing this judgment by the full bench of the Gauteng High Court in Inhlakanipho Consultants versus SARS, and as it turns out, the taxpayer was indeed, as its name suggests, very wise to take this on appeal in the High Court. All right. So just by way of introduction, for those of you who don't know, I'm Nico. I'm the Managing Director of Unicus Tax. This training is intended for my staff. It's internal training and may only be relied upon by my staff. For those of you joining online, for your interest sake only. Right, let's get into this judgment, because the judgment is quite far-reaching in its consequences, and it's important to understand exactly what happened in the case and what is the relevance of this case for the rest of us in practice, because it does bear significant relevance for those of us in practice and for other taxpayers. Right, so this is an appeal from the High Court to the full bench of the High Court, and the issue was effectively whether or not SARS was in breach of a settlement agreement by holding the taxpayer liable for more than what was agreed to in the settlement agreement. That's really what it actually boiled down to, because SARS had said that we want you to be liable for more VAT. So just some background, this was VAT assessments for fairly old periods, 04-2010 and 02-2014. If I remember correctly, the assessments that SARS raised for those periods were somewhere in 2018. And that's relevant for the crux of this issue, if you think about the commercial aim. Because when you read a judgment, yes, we have to understand the principles of the judgment and what the judgment is about, but we must also understand why would a taxpayer take this all the way to the full bench of the High Court? Because it's not cheap to litigate, especially in the High Court, right? So, all right, taxpayer objected, the objections were partially allowed, eventually they ended up in ADR, right, with against these VAT assessments. And in the revised, in the settlement agreement, because you would have seen, those of you online and those in the office, you would have seen that if you go to ADR or even post ADR, sometimes you reach a settlement with SARS, right? And then that settlement is recorded to writing. And I'm smiling because that tends to take some time sometimes. But anyway, so that agreement is then reduced to writing, and in this case, SARS said, okay, fine, we're going to settle this matter and you will owe us 5.9 million rand, right, in the capital amount. SARS then issued the revised assessments in line with this settlement agreement, and the taxpayer paid the amount. Right. Now, the issue is what SARS did is they said, thank you for the payment. We will allocate the payment first to interest, then to penalties, and we'll leave the capital outstanding, right, in terms of Section 166. In the result, that interest kept on running on the capital amount, right? And the taxpayer said, but no, hang on, that can't be right. The settlement agreement that we signed for 5.9 was 5.9, right? It was completely legal, the settlement agreement. There was nothing untoward about it. The taxpayer complied with what he said he will pay and properly construed. Once the agreed amounts were paid, the only thing that remained outstanding was the calculation of the interest, because the contract did say that, you know, this is what you owe, and then we have to calculate the interest, right? And the interest for this tax is for interest on late payment of taxes, right? Don't confuse it with estimation of provisional tax interest. It's 89 bis interest, right? And they said that's the only thing that needs to happen. SARS can't, says the taxpayer, afterwards come and say, well, I'm going to use Section 166 to allocate the payment. And let me refresh your memories of what Section 166 says. It gives SARS the discretion, by the use of the words may, right, to allocate a payment that the taxpayer makes first to interest, then to penalties, then to capital, right? Funny enough, Section 166 or the principle of 166 to give SARS the discretion was introduced for the first time in our tax law by statute in 2009. Before that, it was regulated by common law, right? But what is important is Section 166 gives SARS a discretion. We know in practice, right, if a taxpayer pays towards a statement of account, SARS just allocates it. And they, in doing that, where they do that allocation, they apply their discretion in terms of 166, where they're allowed to do, right? But here, the taxpayer is saying that in the settlement agreement, you said, right, that that this is the final amount, and so you can't use allocation games to collect more from me than what was agreed to. And the High Court initially, when the taxpayer went to the High Court, the court agreed with them, with SARS, and said, listen, no, SARS correctly allocated it, and they were allowed to allocate it in the way they did, so there's nothing wrong with it. And the taxpayer then, of course, not happy with this, took that judgment on appeal to the full bench of the High Court. And the High Court is not very sympathetic towards SARS in the full court, right? In fact, the court, I think if I remember the opening words of the judgment correctly, the court says, there's nothing as certain as death and taxes, and we must pay unto Caesar what Caesar is due, but that should be it. Nothing more, nothing less. And the court goes on to say, you can almost hear the frustration of the judges saying, why should a taxpayer bring an application all the way to the full bench of the High Court just to tell SARS that you must comply with the settlement agreement? In fact, the court goes as far as to say if the taxpayer had asked for punitive costs, he would have awarded it. But they didn't ask for punitive costs, right? But the court said, look, when I read the settlement agreement as a whole, and we have to read settlement agreements as contracts, as we should legislation, read in context and for purpose. And he says, well, when I read the settlement agreement as a whole, it seems to me clear that the parties intended to say, okay, the 5.9 million is what you owe me. And once you've paid that, all that remains to be calculated after that is the interest. And when I read the judgment the first time, I'll tell you that my feeling was, hang on, the court has got it wrong here, because is this taxpayer effectively saying he wants to avoid late payment of interest? Because that can't be. I mean, you can't come to a conclusion in any way, shape or form where the fiscus is out of pocket since 2018 of 5.9, agreed only 5.9, right, and then not have interest at all. But that's not what the case is about. The case is not about SARS or the taxpayer saying there is no interest. It's saying that you must allocate the payment to capital and you can calculate the interest up to that point. The point of the taxpayer's case was not, I'm not liable for interest on late payment. The point is I'm not liable for interest on late payment after I paid, right? Because that is what we settled and that's what we agreed to. And the court says, yeah, that's what the settlement agreement says. It says, yes, you must do the 5.9, and then after that we will calculate the interest. Not we will allocate the payment towards interest or capital, leave the capital outstanding and let that continue to run interest, right? And the court said in the way in which SARS settled this agreement, the way the wording of the settlement agreement reads, the court said SARS effectively forgone its right to apply Section 166. The settlement agreement ought to have read differently. If you wanted to apply Section 166, so we're first going to allocate it to interest and then to capital, you should have said so in the settlement agreement so that we know that the final amount was not 5.9. The final amount was that plus interest continuing after that until you settle the full amount. But that's not what you said in the settlement agreement. And so the court, like I said, was not very sympathetic towards SARS's case. Right. The court upholds SARS's appeal and it says, okay, look, the taxpayer settled the 5.9. You can't say anymore, because that's what SARS used to say until this judgment was handed down to this taxpayer, that you can't say the taxpayer owes you anything in terms of the capital amount. He paid you everything in terms of the capital amount, in terms of the settlement agreement. So that's the end of the matter. You can render an account of the interest, which is what these are the orders the taxpayer sought, by the way. It's not the court coming up with them randomly, but they said, okay, look, first of all, declare that I don't owe capital amounts, I settled it. Declare then that SARS must give us an interest, so calculate the interest and show me what the interest is from then what would be 2018 when the assessments were raised on those periods up to date of payment, not after that. Right? And then the court says, then you can debate it, and if you're not happy, taxpayer, you can come back on the same papers as amended to compel SARS to finalize the account. Right? So the takeaway, I think, from this judgment is, like I said before, is when you read the judgment first coldly, you might get the impression, because I certainly did, that the taxpayer was saying, I don't want to pay interest at all, even though I clearly paid late. I mean, the dispute was the assessments were raised in 2018. So it's not that. The case is not that. The case is the interest that SARS continued to impose on the statement of account post-payment, which, if the assessments were raised in 2018 to date on 5.9, significant amount of interest. And that's what the commercial aim of the litigation was all about. It was not that they wanted to avoid late payment interest altogether, right? SARS's allocation to keep the interest alive obviously was not permissible. Now, the question, I suppose, is how does this, what sort of bearing does this have on other settlement agreements? Because we've seen many settlement agreements. And after this judgment, I quickly went and read through some of them, right? And a sample of them. And the way, of course, every settlement agreement is not the same. Yes, SARS seems to use a general template, but it's not always exactly the same. So one has to look at the specific wording of the settlement agreement. But if you've got a case where you paid the settlement amount and SARS allocated it towards penalties and interest first and left the capital outstanding to keep the capital alive, if you will, you might have a cause of action, right? It might be significant in terms of the number, right? That you might get into. Now, how SARS is going to react to this judgment, I don't know, because although I don't think that this judgment opens up the floodgates, so to speak, right, because you'll have to look at every settlement agreement and the wording of each one to see if you can make the same argument, which potentially you can in many cases, but not all. And it'd be interesting to see how SARS is going to deal with this judgment, because the judgment does, I think, expose them to several claims by several taxpayers. And so going forwards, I suppose they could change the wording, right, to kind of stop it. They could change the wording of their settlement agreements to make it specifically that they're not eschewing, as to use the words of the court, the choice under section 166, to allocate it in the way they do. Or I suppose they can take this on appeal to the SCA, right? And I don't know what the basis for that appeal would be. I'd imagine if I was SARS, and myself and Vickers discussed this, I think this morning, is if you were to appeal this, the argument is most likely to be that section 166, although it uses the word may, is not a discretion that SARS has to apply the payment in that manner. It is in fact an instruction in the legislation to apply it in that manner. In the same way that when you look at Rampasad and another which deals with section 93(1)(d), so you'll recall section 93(1)(d) says SARS may issue a reduced assessment if there's a readily apparent undisputed error. So the word may there is the same as also may is used in section 166, but then in Rampasad the court said, well, may in the context of section 93(1)(d) means must, right? Because if there's a readily apparent undisputed error, it's not like you have a discretion to say, well, I'm still going to collect the tax regardless. Right? I think that there is room to argue that section 166 in context reads differently. And when you look at the history behind the introduction of 166, what I did, I looked at the 2009 amendment, which was at the time an amendment to what would have been the Income Tax Act and the VAT Act, because the TA didn't exist at the time. When you look at the explanatory memoranda that introduced this payment allocation rule, which has been in existence pre-TAA, but it's just carried over in 166 in its current form. The explanatory memoranda actually says the purpose is to introduce a new allocation rule, right? Because as far as I can tell from, I'm not going to pretend like I did a hell of a lot of research in this, but as far as I could tell, the common law position was the debtor or the creditor might decide or might designate a payment as being towards interest or towards capital or towards penalty, right? And so this simply takes away that position or that default common law position and gives SARS the discretion to override it. So the question is, was the legislator's intention to create a new rule that always applies? Or was the legislator's intention, if we read the 166 in context and for purpose, as we must, as the court did in this case, was the legislator's intention to give SARS that discretion to decide on a case-by-case basis how it applies it, or was it not? Certainly in practice, SARS does not decide this on a case-by-case basis. They apply it as a rule, as far as I've seen, right? So I suppose the question is going to be, is if they do take this on appeal, I'd imagine the argument is going to have to be, well, I have to comply with section 166. I don't have a choice. And that is legislation which will trump the contract. Right, so I suppose the question is, okay, if you have a case that's similar to this, how would you tackle this, right? If you have a case where you think, oh, hang on, I've been done in with interest, how do you approach this? So obviously in this case, the taxpayer went for a declarator and for an order compelling SARS to render interest accounts and those sorts of things, right? Which I'm not saying is wrong, of course it succeeded here. I don't know if SARS ever raised an objection to that approach, but of course one way you can do it is if you can consider a High Court application, which of course will be preceded by what? If we want to bring a High Court application, we must first deliver? 11-4. First deliver 11-4 notice. And so if you deliver the 11-4, perhaps that should be sufficient, right? To get SARS, because we have this judgment now that sets a precedent, because it's the High Court, it's the full bench of the High Court, no less. And so you might, with 11.4 alone, come right. The counter argument, I don't think it was raised here, but I gave it some thought, and I've been saying this since the judgment in Medtronics came out years ago, is when you look at the definition of assessment, remember section 104 says you can object to an assessment, right? And the word assessment is defined as being the determination of a tax liability, and the word tax is defined to include interest, right? So when SARS determines interest, that's an assessment, right? Because it's a determination of interest. And section 104 says if you're aggrieved by an assessment or determination, in this case of interest, then you can object, which, if true, will oust the High Court's jurisdiction in terms of section 105 to decide the matter, in which case you'll have to launch an objection. But the trouble is, if you think about 89 bis interest, it is imposed not on an assessment, or at least not on a notice of assessment, it's imposed on the statement of account. No, you won't see 89 bis interest on an ITA 34, you'll see it on the statement of account. And so the question is, well, that route I think remains open to you. And also what is important is if we say the objection route is available to you, which I think it in principle ought to be, the question is, well, when does your period to object start to run? Well, normally the rule is 80 days from date of notice of assessment, right? It used to read date of assessment, pre-TAA. Now it reads from the date of notice of assessment. What is a notice of assessment? What section regulates notices of assessments? Section 96. And 96 says there must be the date for payment, the due date, blah, blah, blah. Does all of that stuff ever appear on a statement of account? No. So does your period to object to the interest start to run? Good luck, SARS, right? Right, guys, that is it for today. As a closing off point is, we come across plenty of cases, right, in our office, all sorts and manner of things. And I thought that I'll discuss one or two of those cases just for interest sake, because I want to keep this short, because we're all busy. But it is good to just touch base on some of the stuff we see. So we recently had a case where the taxpayer had claimed input VAT. It was a foreign company that had established a business in South Africa for the purpose of a once-off, not a once-off thing, but a business venture. And they were registered for VAT, and then they claimed VAT, but they didn't have a proper tax invoice, right? And then they went and they fought with SARS for 2 years on the back of advice from a firm, which I won't mention because it's rather embarrassing, and it's not a small firm, right? On the back of advice, for 2 years, they pursued that input tax claim all the way. The taxpayer came to me when SARS's pleadings was delivered. And I said to them, gentlemen, the invoice is not valid. You don't have a case. Claim it, get the right invoice, you're still within 5 years, claim in the next period. Oh, they didn't know they can do that. 2 years later, legal fees, objections, appeals, yes, the penalties and the interest is one thing, right? But 2 years later, and we said to them, well, that's what you must do. They claimed that the refund came out 2 weeks, right? 2 years they've been struggling to get that sorted out. And that's the thing with objections, and I've said this before in dispute resolution space. To be efficient in tax dispute resolution does not mean simply knowing the TAA and knowing settlement agreements and knowing the wisdom consultants, taxpayer, or whatever the case might be. It is about understanding the tax field in its entirety, because that gives you an opportunity to see, or the ability to see opportunities in cases that if you just, and I have to be careful with what I'm saying now, if you just look at it one-sided because you don't know how the VAT Act actually works, you just know how the tax court rules work, then you will pursue a claim for input tax credits for 2 years when you have no basis for doing that and when there's an obvious solution to the problem outside of litigation, which, quite frankly, when I said to the taxpayer, it's ridiculous that you've been sitting without this money for 2 years. I don't know what they told you and why. And when they went back to the people, said, listen, why did you say, oh, yeah, you can do that. 2 years. Anyway, right, guys, I'll take questions from, I am in one stage going to do the Erasmus judgment, which is an SCA judgment handed down last week. And although the Erasmus judgment deals with GAR, its implications go, in my view, much further than simply the GAR. And it talks to what you must look at when you look at SARS' letter of audit findings compared to their Rule 31. Because I have seen, in many cases, I have seen that what is in the audit findings and what's in the Rule 31 is often not the same, right? And that is a potential problem for SARS. And if you hold them accountable, because remember, don't think for a second that SARS will, on its own accord, go and realize, oh, hang on, I didn't say that in the audit filing, so I can't say it here. It's not going to happen. You're going to have to call them on it. And in fact, we've got 2 applications in the tax court pending at the moment to do exactly that, right? I would have thought, to be honest with you, I would have thought that, of course I will think so, but SARS ought to have conceded to that, but yet they're forcing us to litigation, which is fine. We'll go. And I'm pretty confident that not only will we win, we'll also get a cost order. And I'd be surprised if we don't get a punitive cost order, which is sad, because who do you think pays those costs? Right. Anyway, but be that as it may, I'm sure they have their reasons. Thank you very much for listening, and then I'll see all of you again next week. For those of you who joined late, this session, like all the other sessions, are on the Unicus Tax YouTube channel, and you can go and check them then. Thanks for joining. Keep well. Bye-bye.